Something significant is happening in global financial markets that most regular investors are not paying close enough attention to. It is called the Great Rotation, and it could reshape which parts of your portfolio perform best in the second half of 2026. What the Great Rotation is: money is moving systematically and at scale from high valuation technology stocks into undervalued traditional businesses, banks, consumer staples, healthcare, industrial companies. While the Nasdaq falls, the Dow Jones hits record highs. While chipmakers drop 7 to 13% in a session, Visa and Walmart rise 3%. Apple surges while Nvidia falls. The rotation is happening in real time right now. Why it is happening? Technology stocks surged 80% in the first half of 2026. At those valuations, the future growth of every major AI company is already priced in at best-case assumptions. Any disappointment, slowing growth, missing earnings estimates, rising costs produces sharp falls from those elevated levels. Meanwhile, traditional companies in banking, healthcare, and consumer goods have been largely ignored. Their valuations reflect modest expectations. Their underlying businesses remain solid. When money seeks value, it flows to where expectations are lowest and reality is best. The earnings season test coming up. AI-related stocks with lofty valuations face their next major test in earnings season right now. Strong earnings alone may not be enough. Management teams need to demonstrate that revenue growth, profitability, cash generation, and forward guidance can justify the valuations already embedded in share prices. This bar is very high. Missing it even slightly produces dramatic falls from current prices. Where the opportunities are emerging: healthcare, particularly innovation around GLP-1s. Weight loss treatments is reshaping consumer behavior and creating ripple effects across food, retail, and healthcare companies. Financial services companies and insurers trade at valuations reflecting modest expectations despite solid fundamentals. These sectors offer what the market is increasingly looking for: reasonable valuations against real business performance. What this means for your index fund strategy: a broad global index fund automatically participates in the Great Rotation. As technology falls in weighting and traditional sectors rise, your index fund rebalances automatically. This is the structural advantage of index investing. You do not need to predict the rotation. You own everything. The market does the rotation for you. This is another real-world example of why trying to time sector moves with individual stock picks is unnecessary and risky for regular investors.